All right, it's my pleasure to introduce Dale Anderson, a leading expert in risk management and insurance. Dale is a lion in the field, has been in the field for longer than you have been in existence. He's worked his way up through the ranks and is now principal and founder of RMH Risk Management, where he advises corporations, contractors, public entities, property owners, family businesses, and inspires the next generation of risk managers such as myself. He brings a rare combination of technical knowledge, mission-oriented, caring for his clients who are always his friends. Mostly his friends. And today he'll walk us through key issues of insurance for business and property. He's distributed the Understanding Contractual Risk Transfer and the Role of Insurance, which will help you understand fundamental key concepts as well as the case study. So without further ado, please join me in welcoming Mr. Anderson.
Thank you. Yeah, and hopefully we can make this kind of an intimate discussion. That's kind of how I work. So I really encourage questions and answers and things that we can do to give you more of not a textbook application of things, but real world, because I find that nothing's textbook anymore. And a little bit of background on me. Been in the business for just under 44 years. So that defines my hairline. I've left a lot of hair around the world. I've been in over 50 countries practicing with Fortune 500s, as well as in late 90s, I decided to go and take all of the practices that I learned in risk transfer in the Fortune 500s that they do constantly, move them into commercial lines. What I mean by commercial lines, these are like family offices and things that never really capitalized on, the multi-billion-dollar ideas that, the Toyotas and the Mattels did forever. And now I'm taking that into the homeowners. So I created another company, which is called HomeSure Alliance. And I'm bringing together the 13 million homeowners around California to give them power, which has never been done before. Because if you're aware of what's going on in our state relative to insurance, cost of insurance, the inability to get insurance, the unavailable insurance, because of the changing world. So I could talk a little bit about that. So I kind of want to incorporate this idea of what I have seen in the legal practice and what really doesn't work anymore. It used to be 50, 60 years ago, is outdated in my industry, doesn't work, and that's why we have the problems that we face. So I don't know where you sit and what type of law or where you want to practice and why you're getting a law degree. Those are questions that you should be asking yourself. And what does that mean in a world of AI? What does that mean in a world of complexity? And what does that mean in a world of uncertainty? And I deal in risk uncertainty. By the way, Giants, love them. I grew up in San Francisco, but that is really where I sit. So there is this chasm right now in terms of what business owners, large, small, and different, are afraid of, and that's risk, uncontrollable risk. So it's going to be your job, your responsibility to sit, whether it's in a corporate counsel position, whether it's working with buy-sell agreements, whether it's working with international interests, doesn't really matter. Your job, you have a fiduciary responsibility to transfer risk on behalf of your client. So, whatever you're doing, you're going to have to do, and you're doing your job well if you transfer 100% of that risk, like a teeter-totter, even in law, it uses a scale. So what you're going to try to do is put as much weight on one side of that teeter-totter as possible, which is hold harmless, indemnifications. You're responsible for everything, even acts of God, force majeure. And you're going to think that you're doing your job if you do that, okay? And you're going to protect the firm. What I'm telling you, that's not the case anymore. Because no one can transfer that risk. Tenants, landlords, buy-sell agreements, as I said, no one can transfer that risk solely anymore to what's called an insurance company. All right? So it's your job to do that. So tell me this, what do you think the most important coverage is in an insurance policy? What's the absolute most important?
General liability?
Okay. Anybody else? Come on. Even in your auto insurance, that when you get in an accident, what's the most important thing you're buying in an insurance policy? This will drive your careers. Defense. Defense is the single most important aspect of an insurance policy, whether it's an auto, a GL, what have you. Know why? Because when you have any kind of a physical loss or damage, you're going to seek defense, and that's going to be costing you $800, $1,000 an hour. And you want to make sure that your client can access that. And you're going to start asking your people within your organization, what type of insurance do you buy?
Time out, if that's okay with you. I just want to drive that point home because this is one of those things that's very counterintuitive. But when you have an insurance policy, right, and let's say 99.999% of what happened is excluded from that policy, and 0.01% of the claims is potentially covered, potentially, because there hasn't been a judgment yet, potentially is allegedly covered by the policy, the carrier has a duty to defend your entire action. Now, at the end, they can come back and claw some of that back from you, right? But the point is, a major, if not the major benefit of having insurance is what Mr. Anderson is telling you right now, is just to trigger that duty to defend.
So if that's the one thing you get out of this whole discussion is when you're faced with your stockholders, your owners, your employers coming after you and saying, okay, Diane, what's the deal? Who's going to pay for all this? You need to do your homework and you need to find out where you can seek coverage. And it might be through a variety of policies. And it might be dating back 20, 30, 40, 50 years that policy was written. That's what happened in the asbestos claims that we ran into back in the 80s and 90s. We were paying huge amounts of money for policy archival work to research the policies that were driven in the 20s and in the 30s to bring those claims because they're occurrence policies. Okay, so even though the product was made in 1925, it caused damage in the year 2025. So we're able to do that. And under the Armstrong Act, there is the duty to defend, but there's also, once you bring one carrier in from 1925, it's their duty now to bring all of the other carriers in all the way current. Okay, so they're on the hook. And if they want to seek indemnification themselves and defense, they have the duty to bring every single carrier in, not you. And that is a critical issue. So look at the Armstrong Act and read it, understand it, because that is going to really give you the leeway in order to give your clients sound understanding and defense coverage. So always remember that. Defense is critical. Without it, you're not going to get any indemnification, and that's the payment. All right. In every single transaction that you have with an insurance policy, you will not get a verdict. verdicts are rarely given because of precedents. And no one wants to spend that money. So you're going to have to settle with your insurance companies. And you're going to be taxed to sit down and mitigate with them. And that's probably where you are going to find your most challenging, not in a court, but sitting down with insurance companies' attorneys that are extremely savvy. You know, there's no, when you watch a football, baseball game, what commercials do you most often see? Allstate, State Farm, all of these characters now that they have generated. Do you know how much money is made in insurance compared to what is paid out? If it is the most lucrative career because of the way that they are able to avoid taxes and how they discount losses that which have never happened. They're called incurred but not reported. They're able to build up huge surpluses of their income, which is tax-free. Okay, they don't follow FASB rules of accounting, and they don't follow the law. So don't fool yourself. If you study all these different things, and Alan can attest to this, they have their own ways in which the policies are legally defined, which is different than what you're learning.
I'd like to just add, just because we were just talking about this in the beginning of class, there are really two sets of laws. There's the laws that you'll find from courts in textbooks, and then the laws that you'll learn about in certification courses, in continuing legal education courses. One is run and sponsored and basically framed by the carriers, right? That's what they want you to think is the law. And the other is what the courts actually say. But the courts don't actually say all that much, because 99.99999% of cases are either not brought and settled, or brought and settled and arbitrated, just don't make the law, right? So there are two sets of laws. So when Mr. Anderson is saying is they don't play by the law, they're playing by what they say the law is, but it's just not what the courts are saying the law.
So what you'll find is that when you're dealing with counsel, insurance counsel, what they are going to do is spin the table on you. And what they are going to do is make sure that nothing that they entered in creates any change in the case of precedents over the last 150 years. They do not want the system to change. You know, understand that in our world, people benefit from brokenness. Broken systems allow certain people to profit. All right. So just understand that's probably going to be one of your most critical points, because you're going to deal with it no matter what. You're going to deal with it. No matter whether you get into real estate, or you get into manufacturing law, or you get into international law, which is changing incredibly at supersonic speeds right now because of different changes in politics, socioeconomic, countries that were third, in the chain now are becoming superpowers in themselves, and they're starting to impose their law on what was traditional U.S. law. And I'm dealing with that on a daily basis. They're just getting more powerful. So I put something together. I don't want to spend too much time on this. I hope you have questions, but I'm finding that if we just jump to the foundations of contractual risk transfer, we kind of talked a little bit that's on page 4, Alan. Are you all comfortable with risk transfer and when you're dealing with a contractual issue, whether it's at home?
No.
None. Okay. Like I said, whether it's your company or you're dealing with a client, you're trying to transfer risk as much as you can for indemnification and hold harmless, all of these kind of terms. to that party in which you feel has the responsibility or the legal liability for it, like in tort law. That's what insurance covers, tort law. What it doesn't cover is willful misconduct or gross negligence. If that's the case, anybody would go out and cause crime and, you know, profit from it. And if they get sued, they get an insurance policy for it. So willful misconduct, fraud, all those things are not covered, okay? And I'll give you an example of this. A very notable real estate monster of a man in LA had an assistant for 35 years. What he didn't know as he got older is that she was skimming millions of dollars off the top. Okay. Ended up that she had funneled this money, which was $20–30 million into different accounts and different things around the world. Well, it came to their attention of the legal counsel of this real estate company that this is what happened. And the guy was 90 years old. Okay. And so they came to me and, okay, we've had this situation. I said, well, number one, you put way too much trust in people. Okay. Way too much trust, where this woman did everything for him. But what happened was, as soon as I said, well, you know, we can make I had plenty of coverage for a crime policy. The crime policy, you respond to that. But when you have a crime of that size, you know what happens? The FBI gets called. And the FBI comes in and they take over the case and they want to interview everybody, find out what happened. Well, they didn't want to subject this certain individual because of political reasons, economical reasons, just embarrassment reasons, to being ridiculed by the FBI. So what happened? No coverage, because they wouldn't allow the policy in its due course to sell it. So these are the kind of things where I'm talking about, you learn in a textbook, but it's not reality. You're going to get taxed by people's wackiness and what they do. And you're going to have to try to take that and recover from it. And that's, you know, what your job's going to be. So these are the kind of real situations that you get in on a daily basis when you're attempting to solve legal problems for firms or individuals that you cannot solve in a textbook.
It actually might be a good place to maybe bring home a little bit to you all the nature of risk and how lawyers tend to manage risk. So when you get through law school and you pass the bar on the first time, right?
Well, that's why you're coming here, right?
Right, exactly. And then you get a job and you're tasked with identifying risk. You're reviewing documents, whether they're loan documents or partnership documents or due diligence documents, and you see, whoa, you know, if this happens, then that exposes my client to all this sort of risk. That is risk. At that point, you have two choices, right? You, meaning you and your clients. You can eliminate that risk by getting insurance, which is a contractual transfer of risk, right? Mm-hmm. Or you can accept the risk, right? But the point I think that Mr. Anderson is making right now is that even if you are able to transfer the risk contractually to the other party, to an insurance carrier, it could be, you know, there are lots of different ways to transfer the risk, right? But even if you're able to legally and contractually transfer that risk, your client might be weird, might be smart, might be whatever, but still that might not be the only reason to exercise the policy.
Yeah, the policy, and also just the overall political arrangement that you have with your client or your vendor. I mean, it could be a family member. I see that often in real estate office, where one family member is suing the other one for their lack of fiduciary responsibility under their care and custody control of their assets. I see that all the time. Okay. And it breaks up the family. You get caught in the middle. you're going to get fired. I've seen it because someone's going to take the fall. And it just gets very, very complicated. So choose your area of law wisely, is kind of the idea there, or just have, just an understanding that you're going to get involved in some pretty personal matters, So as Alan said, there's all sorts of ways to transfer risk. I deal in both insurance and transferring and assuming but that's becoming more difficult to do because the insurance companies don't want to do it anymore. They're leaving, like the state of California. And they do that by, number one, using excess and surplus lines markets versus standard markets. And this is a critical point, is that we're finding in California, standard markets are leaving the state of California because they're regulated by the government in terms of what they can charge, what they can cover, what they can't cover. So there are now excess surplus lines markets that are licensed, but they're not admitted in the state of California.
This is the definition of the exception makes the rule.
Yes.
So generally speaking, the Department of Insurance of California regulates the admittance of insurance carriers into California, but at the end of the day, we need to provide insurance. And so if there are not enough admitted carriers, then the Department of Insurance will allow non-admitted carriers to provide the insurance. And today, I think there are more exceptions than rules.
I'll say that 90% of the business coming in for like personal lines is all excess surplus lines. That's essentially means that they don't have to play by the rules. There's no barrier on either side.
That is the right look on your face.
Yeah.
Michael's face look, that's the right look.
There's no barrier. They can do what they want to do. They can, decide what they don't want to cover, and they can charge any price they want. And that's why we're seeing auto insurance creep up, homeowners insurance quadruple, thousands of percent increase in that. And the government is anti. They can't do anything.
They need to be able to allow carriers to provide insurance.
See, what has driven us into this position is, number one, trying to put too much risk onto the insurance company's shoulders. I could give you statistics in terms of, the premium that comes in and, compared to the losses that are paid out. But we use a combined ratio. What that means is that we're going to look at expenses of the insurance company. We're going to look at what they pay out and what they have to put in arrears for future liabilities. It's called a combined ratio. So really, insurance companies traditionally at a combined ratio can make money at 1.26. That means for every dollar they take in, they're paying out 1.26, in claims and expense. They're making money on that because of the interest rates. They take all this money in and they invest it wisely. Okay, and they're making the difference. But when interest rates come down, or there's tariffs, or there's these kind of things, all of a sudden the combined ratio starts to increase where they can't make money. So I'm not here to throw stones only onto the insurance companies. Okay. Yes, they're considered to be the big bad, Darth Vader of our world. However, there are some real understanding that has to be made and why we're in this situation we're in right now. Number one is government. Government primarily regulates things in order to build votes. Okay, I mean that's their
To get reelected.
Yeah, they want to be reelected. So back in the early 80s, Proposition 103 came about, which was regulating insurance. And what that did was it said that you can't charge more than 20 cents. Even though the going rate is $1, you have to do that because that means that you're going to get more votes. Okay? So government not understanding how the game works, their motivation is votes. All right? The motivation of the buyer is to get what? The cheapest possible price for their car, their home, their boat, or whatever it is. and disregard coverage. Half of you, or maybe all of you, have no idea what's covered under your auto policy, or if you have a home, what you have. And we're learning that out in the fires right now because a lot of that's being excluded because they didn't know. They just wanted the cheapest price. So some of the blame is on the buyer. You can't get a Cadillac at a go-kart price. You just can't. But ignorance in that calculation comes out only when you have a loss. You go, what do you mean? I wanted the Cadillac. And your agent goes, well, no, you wanted the cheapest price. So you sue your agent. Okay? For not representing you correctly. That's what's happening today all around Malibu and the Palisades and elsewhere. So again, government, ignorance, vote driven. The buying public, ignorance, cheap price. The insurance companies, what they're trying to do is what? Make money. Not to pay claims. That's their motivation for their shareholders. You see it's broken? You see it's broken. No one is willing to balance the scale and do what is right so our contracts work correctly. I can't tell you how many attorneys have no idea how to structure a contract. They're terrible at it because they're trying to push too much in one direction, understanding that sometimes too much of a good thing could be a bad thing. And that's when it boomerangs around and hits them straight in the eye because they were being greedy and trying to get. So remember, everything was built around the legal system for a balance. And I'm going to go through that in a lease I'm dealing with right now with the Singapore people that don't understand that, and their attorneys don't understand.
Let me just, for the sake of effect, recapitulate what Mr. Anderson is saying. Insurance is regulated by governments who care about votes. Insurance cares about profits, and by caring about profits, they're looking to minimize coverage. Policyholders care about price, and in caring about price, they also want to maximize coverage. So you have a complete and total chaotic system where there is a zero-sum game between insurance and policyholders. Insurance, right? But now let's say if it were a landlord-tenant and this were the landlord and this were the tenants, we'd say, okay, if the rent is $100, right, and it costs me $70 to provide that rent to you, I'm making $30. So I want to charge as much rent as possible so I can make 31, 32, right? So there's a zero-sum game, right, between the landlord and the tenant, but the government steps in and says, but there's some basic social housing rights you need to provide, and you can't just reduce expenses in order to maximize coverage. So the government tries to do that theoretically over here by regulating what is a fair amount that the carrier can cover, but they're not doing it in a way that is effective, right? They're just doing it in a way to get some cheap votes, right? And so as a result, you have completely out of whack regulations by the Department of Insurance in order to garner votes at the state level. And what you have is, as we mentioned earlier, rules that are only applying through the exceptions. So you have,
and that's both internationally and here in the US. Okay.
Are insurance companies completely governed by state law? Like, I know nothing about it.
Well, they're governed by best practices from a, there's accounting and finance, stipulations, regulations, SEC regulations, stipulations. There's also aspects of every state has their own Department of Insurance. So understand when they dip their toe into the US, it's not just California. They have to adhere to Montana and they have to adhere to New York, which the motivation of the governments in New York are completely different than in California, and just what's recoverable or what's not recoverable. So you guys see, I'm not throwing stones completely at the insurance company. They really, remember, insurance was built in a pub in London where wealthy people came up and they put their name on a chalkboard for cargo ships going to and from the US. Will it make it? Will it not make it?
What's the over under?
Yeah, exactly. It's gambling. Okay. And so individuals put their name down for 5%, 1%, 2%, 3%, 5%. And they get oversubscribed at 120%, and they go back to the 120%, say, hey, if you don't do it for this price, you're not going to get it. They're involved. There's the marketplace. Oversubscription, too much supply, price comes down. Okay. This is how it was done, and that's how buy right now. Real fail in any way, shape, or what have you, it creates a hiccup in the recovery. The fronting carrier is guaranteeing that won't happen. But what's happened is the fronting carrier has been doing that so long, so many, 10, 20 of these carriers are failed. Now, instead of, they remember when they sell 10, 90% of the premium, they got to give 90% of the 90% of the liability. They have to give 90% of the premium away. So for $100 premium, that carrier is putting themselves up to guarantee all of this, but only for 10% of the premium. So what happens if 20, 30, 40% fail? They still have to come up with now 50% of the indemnity. You see that? This is what's happened. Okay? This is what's happened. And so the carriers are faced with this. I can't guarantee all this anymore. Even though they're trying to limit my loss to 10%, I'm still on the hook. So that's creating, what's coming out of here are different ways to do this now. And what I deal in primarily with the policyholders and insurance, I start educating like I have with Alan's family and others, start taking the risk yourself. And that's where we generate things called captive insurance companies. And that's where I advise clients to set up their own insurance company on behalf of their own company and start retaining risk, but charging themselves premium. Spread the risk to a point where they have risk, okay? They're actually selling risk. And that's where we have, like in real estate, you have, a holding company, but they own 80 properties and they're all independent LLCs. That's how we structure real estate. So now if the management company buys a captive, they're able to go ahead and transfer the risk from the LLCs to the captive on a tax deductible basis. Remember, when you pay a premium corporately, that's a deduction. If you pay the premium to yourself, there's no risk transfer. So it's not deductible. So that's why you can't just go and say, I'm going to be self-insured and I'm going to send $1 million to my bank account and take a tax deduction for that million. Well, you can't do that. That's illegal. If you sell it to AIG, you can take the deduction. So we create these different things, to get rid of this mess. Where now you start taking responsibility for your own property, your own fleet, your own this. After a while, you're building up 20, 30, 40, $50 million of capacity. And you're comfortable with it because it's your family office.
The best example of this is, let's say you're working real estate in California, right? So until I met Mr. Anderson, my company had earthquake insurance, right? One of the first things we did after meeting Mr. Anderson is cancel our earthquake insurance. Turns out, not that this is the same for everybody else. I'm not advising anybody else what to do, but I'm just saying for us, it turns out that it makes more sense to self-insure for insurance. for earthquake insurance, okay? So if we just put the money on the side, that's good, right? But if we just put the money on the side, we don't get a deduction for putting that money on the side. We don't get credit as far as taxes is concerned for putting on. So what the captive insurance does is it allows you to put the money on the side for a rainy day. So you're self-insuring, right? But the manner in which you put the money aside, if done properly, is extremely tax beneficial as well.
Yeah. And then what happens too, if you're commercially geared, meaning, I mean, you have your clients really retail or what have you. Remember, you can now charge that money back as cans.
Common area maintenance
Yeah,
charges.
yeah.
Right.
So remember, you're not only getting a tax benefit by putting it over here for a rainy day, 40%. You're also able to, you're creating a premium there. So you're paying your insurance company, let's say, for that $1 million, $300,000 a year. You can give it to AIG and it's gone forever. But you can keep it into the family circle by putting it over here, take that 40% tax deduction, take that $300,000 and cam it out to your clients.
Your
Your
retail
tenants.
clients, your
So-
Targets, your Whole Foods, right? They're all reimbursing you for can charge.
So you're basically making money.
So I want to make sure, because I got that face from Michael again, which is a very honest, I'm not, what you're talking about face. So what Mr. Anderson is saying is, let's say you own a shopping center, right? You're a real estate guy, look out. You own a shopping center and your tenant is paying $3 a foot rent, right? In addition to paying that $3 a foot in rent, they're also paying to reimburse you for camp charges usually. Okay, so there's a cost for security, there's a cost for cleaning the parking lots, there's a cost for common area electricity, there's a cost for insurance. And if the insurance that's being reimbursed is really your own self-insurance, then not only are you setting aside the money for a rainy day, not only are you getting a tax deduction for what you're putting aside, you're also getting reimbursed for that money from your tenants. There we go. So
Do you understand now? You're actually making money. You're an insurance company now. And you're now creating value in turning what was traditionally an expense to your company into a profit. So when you go to your owners, you go, you know what? We can make money by doing this ourselves. And remember, what we're covering typically under a captive is not the catastrophic loss. In earthquake, remember what Alan's talking about. We're self-insuring the first 2 million, 3 million, something that our balance sheet can handle. And if we build up 20 million after 3, 4, 5 years of our own premium, tax deductible, well, we can handle that 3 million deductible. We buy insurance on top of that one. Okay, that's catastrophic, but it's cheaper because we're pushing insurance higher and higher. Or it's cheaper. Make sense?
statistically, the risk to the excess carrier, that top part above the fronting carrier. So if I'm self-insured, I'm the fronting carrier, or if you buy real car insurance from Allstate, they're the fronting carrier. Now they're only paying or responsible for the first portion of the policy, the primary portion of the policy, right? The above that amount, right, comes from the people in the background who we don't know exist. So those people in the background are betting that 99 out of 100 times, none of those policies are going to breach the primary, right? So it's never going to get past the front gate, right? And so therefore the risk of anything touching the excess is much lower. And so they're pricing that excess risk differently than the primary risk. So if you look at the insurance tower with the poor markers, which I apologize for,
We'll see.
there are different prices for the first part of the risk, like the small fender benders, right? And then the car flips, right? They get in the different kinds of, but they're both the same insurance policy, but they're different events of loss. And so the people who are going to be triggered in the bigger events are pricing those excesses in a different way.
Yeah, so understand in a commercial risk, your risk in a commercial risk, is to say real estate, is primarily in water damage, graffiti,
malicious mischief kind of things. You know, you guys go out there and spray paint everything. And then copper, you know, people love to tear copper out of buildings, okay,
Subways.
with machinery. But primarily if you own a building or a house, the majority of your risk is water damage. Okay, and things that are like, you know, $100,000 loss, $200,000 loss. Well, ultimately, if you can start paying 90% of the premium is really in this, because it's frequency. It's frequency loss. And that's where carriers charge the biggest piece of that dollar. So the key, I teach my clients to self-insure as much of this as possible. Okay, then buy catastrophic insurance at less of a price, because remember, this is for the, you know, massive earthquake or the massive, you know, fire that happened out here, you know, that no one can control. But it's cheaper because the probability of loss is much less than it is down here. So this is where you can capitalize on 90% of the premium and throw that back into, I call it kind of the circle of life. And that's your generational wealth of your family office or your corporation. Remember, we want to, like in estate planning, we want to keep everything going around and around and around in here. Everything we kick off is a loss to the generational wealth. Everything.
So self-insuring is a way of paying yourself and keeping it in that circle.
Yeah, why do you think families, when they're wealthy enough, they offer mortgages to their kids? Because their kids' payments, mortgage payments, are going back into the circle of wealth instead of going to Wells Fargo, which they're never going to see again. So that's why it's a wise strategy for an estate planner to say, why don't you lend $1 million, if you have it, to your kids? It generates income for you, that's taxable, but also kicks money in to the wealth of the family, which is going to come back to the children, because you know what? Once mom and dad die, they grant the house, the loan's paid off. There's no more loan. So all of a sudden your kids have no mortgage, but they own a house at age 45, 40. So the key is, how much of these crazy expenses out here can we throw back into and make money? And insurance is the one that people always forget about, because they think it's just something I'm gonna have to pay forever and ever, and I'm never gonna see it again. That's what makes owners angry. Because so many people go, gosh, Dale, I haven't had a loss in 20 years. It's coming. And then what we do in here, we teach the insurance how to be risk in the retention, how to mitigate risk. And because it's their own dollar, you know, they're gonna upkeep their building. They're gonna change the faucets out because they leak. They're gonna fix the toilets. They're gonna fix the cracks in the hardware.
You drive your car differently if you own it or you lease
Yeah,
it.
you're gonna drive, yeah. If you lease a car, it's like, who cares? It's kind of funny. A friend of mine lived in Malibu during the March Miracle, and he had a Mercedes. He lives right on the beach. I won't tell you his name because he wouldn't like this. But after the March Miracle, his car was underwater. Right down the street here. His Mercedes was underwater, and Channel 5 News came out and said, well, Mr. E, what happened? I see your car's underwater. He goes, that car? He goes, no, that's the bank's car. Okay? He didn't care. He's going to get a new car anyways. It's leased. That's why I have transferred my practice in the 2000, not to syndicated real estate companies. Syndicated means they have no money. They borrow money, like funds. They go buy real estate. But if things go wrong, they put the keys in the mail. That does nothing to protect me, the insurance companies, whatever, you know, because they're not putting anything back into it. But family offices, I found, keep it forever. They're gonna upkeep it. They're gonna keep it. They're gonna protect this loss. I'll protect this loss all day, but I want to transfer this loss 90%. If I could get 90% or 120% of this premium back, I'm making money. Right? I'm making money.
But there's got to be an initial cost to setting this up. Like, how much do you have for it to be worth it to set this up?
Good point. Excellent. To set this up, you have to have capital to back it, okay? But remember, it's not a regulated insurance company. So to set this up in the state of Montana, let's say, you have to put up $250,000 of cash capital. You can start issuing $1 million policies. Because remember, what's going back to insurance. Remember, when you buy an insurance policy, the carriers put up $1 million of liability for your $1,000 premium. Okay, you're doing the same thing. You're putting up $1 million policy with $250,000 of capital because most likely we've done our due diligence and you're not paying losses. You might be paying a trash can fire or graffiti. That's fine. Those are $5,000 losses all day long. We protect you up here. So it's $250,000 to go into business as a captive insurance company. And then maybe, $20,000 a year to have the actuaries. Those are the guys in the background that do all of the risk calculations here to make sure we're well positioned. We're charging the right premium.
Back off.
Yeah. And just whatever. So it's really about $280,000 to start this up. But if your premiums are 3, 4, 5 million, that makes sense. Okay? Because again, we're capitalizing on this. One of my clients is an apartment, was an apartment owner. They're the largest apartment owner in Nevada, and they're based here in Long Beach. Their GL premium was averaging about 4.8 to 6 million a year.
That's just for nothing, general liability.
No losses because they have 7 attorneys on staff. So they fight everything, bed bugs, whatever it is. They're known to fight, so no one bothers them because they're not in deep pockets. They'll spend $1 million to defend a $250,000 case because they're so aggressive. So what I did, I created a $3 million, what we call self-insured retention. So all of a sudden, remember, of that $6 million premium, we were able to send $3 million of that now to a captive to cover the $3 million aggregated retention, their retention. Okay, so that meant they were spending only $3 million for the excess. But with a self-insured retention now, that came down to like 560,000 because now it's an SIR. It's $3 million. It's not first dollar. All right. So all of this, what was a $6 million premium, we threw $3 million back into their captive. All right. We also reduced the cost of this down to $600,000, and we bought a fronting policy for this. That means again, the fronting policy sits here, and and we used their captive as reinsurance. You get that?
So now there are 3 people involved.
Yeah.
Right? You have AIG, who will be the fronting paper, so that, you can show Wells Fargo if you want to get a mortgage or anything like that. We have a AM Best rated insurance company providing the fronting paper, but that fronting paper doesn't provide really very much.
It's really a transfer, right? And that costs maybe $80,000, whatever,
And
just to show a name.
Propping up that facade is your self-insured retention, your SIR, your captive insurance policy, right? They take the real risk on the first 3 million of this
Remember,
example.
you just funded that with $3 million that you would have sent to AIG.
Yeah. And then on the in excess of that, you have the
Standard market.
the standard policy.
Which
So
is cheaper now because you got 3 million, not just 0 deductible.
so it's self-insurance with a cover of Allstate or AIG,
Yeah.
and that cover is what satisfies a lot of lending requirements,
Right.
because they don't know, those lenders don't know how to underwrite family offices, SARs or captive insurances. So they need someone like with a good resume that they can trust.
Exactly.
So you buy the resume.
So these are kind of, as Alan pointed out, these are solutions that we provide. We call these either off or on balance sheet solutions to what is traditionally a mess. And you're just throwing money away. All right. So these are the kind of concepts that we, on a government standpoint, we don't do business in the state now. That's a way to avoid government regulations. And that's what's happening to a lot of companies right now. They're leaving. When I started in the business, California was a leader in Fortune 500, HQs. Now you can't find them. And that's what drove me into this, was because I was competing against my, other producers who were still fighting for less and less meat on the bone. So again, taking these concepts that Toyota does every day, Dole does every day, and taking those to people who've never seen it before. Now, all I'm doing right now with my company called HomeSure, I'm taking this to the homeowners who are ignorant and wouldn't even understand this. But that's the next generation, if you want to call it that way. So again, I'm trying to just, in a nutshell, in 40 minutes here, just teach you that, insurance isn't very sexy.
You make it sexy.
Honestly, I didn't grow up thinking I was going to be an insurance broker. I really didn't. I was a banker for Security Pacific Bank, who went BK, bought by Wachovia. But I got involved with Marsh and McLennan, and they taught me all this. What it's done for my career, I've been on North Sea platforms, okay, in the middle of the North Sea. I've been in coal mines, down 1.5 miles, knee deep in water, with, 30 kilowatt power lines running long wall miners. That's what carves the coal out of my client was Westfield under the Twin Towers loss. So, I not only lost 400 employees that I knew, and I was there the week before.
Recording in progress.
I've been in massive losses for Dole Food Company in the spinach E. coli situation where it killed a lot of infants, 250 plus million in damages. I have a lot of scar tissue. Okay, a lot. I've seen tragedy. And so it hasn't been a sexy career, like maybe working for Hollywood or entertainment, where you're hobnobbing with, the elites. But I'll tell you what, I have seen things that people will never see. And I can bring that single string, which you need to do, of common traits that I see overseas here, and bring them to your client. But remember, you got to look at 10,000 feet. Don't get into the checkbox. You're going to die in the checkbox. You got to think outside of the box. That's your value.
Especially after today.
What?
Especially after today. Before today, they can claim no one ever told me.
Yeah. And I'll tell you, and I like to just, what time we have left, just kind of go over the leads.
We have a half an hour.
Okay. Just to kind of show you what I'm dealing with right now in one case, because of Singapore law, because of US law, because of miscommunication, because of languages, miscommunication of what is legal in Singapore and what is not legal here, and how that has subjected my client to the devil in the detail. Okay. And that's what you're here to eliminate, is the devil in the detail. Yeah, that's where you're going to earn your money. coming up with these kind of solutions, being aware of them, but also being accountable to making your client money.
And no one wants to read those policies.
Yeah, you know, I just created an AI for Newfront, an AI solution to check policies. Took a year. So AI now, you put a policy in, AI reads it, and it comes back to the client or the broker with all the problems with the policy. Okay? That doesn't solve the problem. You can AI yourself into oblivion, but it's not going to solve, now you know about it. And sometimes that's worse when you know about it than if you were ignorant to it. Because now the law changes in terms of my fiduciary responsibility. If I know it's excluded now, I have to find coverage for it. Or I have to tell my client, you're not covered. And you know what they might do? They might fire me because of that. And go to somebody that's going to tell them what they want to hear. And that's what's going to happen to you. If you tell your client, hey, figure this out.
Much easier if you're the attorney than if you're the broker, though.
That's right.
If the broker, you're expected to be able to solve the problem. If you're the attorney, you're only expected to identify the problem.
That's correct. That's very, very clear, yeah. Attorneys love to point their finger at us
Yeah.
brokers. So, yeah.
I understand taxes play a big part in the insurance system. Well, how about the inflation? Like how big of a role does inflation play in the system?
Inflation,
Yes.
in terms of what, just the overall
The rate.
cost?
The inflation rates, just the amount.
How does inflation impact insurance costs?
I'm sorry, appreciation.
How does insurance? Well, inflation affects anybody and everybody in the same way. It screws with supply and demand. So with insurance, what they will tell you is that inflation will push up the premiums, okay? But inflation also reduces the supply of insurance. So it creates even more of a chasm, and that's what you're seeing with homeowners insurance right now. They blame it on inflation, but it's a desire not to insure.
Because what happens, just to make Mr. Anderson's point home on that example, right? You have buildings that were built at a time and they were insured for a cost to replace for a time when the cost to replace was, let's say, $1 million.
Right.
But because of inflation, the cost to replace is now, let's say, $2 million. So now, how does that insurance policy?
Maybe this will hit home. Did anybody lose a home, your family, in the fires at all here? Probably not. Okay. Well, I've spoken to a lot of people that the insurance company set the value of their home at $600,000 to replace today. Okay. Might be good if your home was the only home that was damaged. But if you have 15,000 homes damaged at that, okay, material costs are going to go up, labor costs are going to go up, because all 15,000 are you going to that one contractor all at the same time. So what's happened now, it's not 600, it's 2,000 a square foot. So the insurance companies are coming back all around here right now going, I know it's going to cost you $3 million to put your home back, but I sold you a policy for 600, and that's it. You're on your own for the remainder. And most of those homes were second, third generation, meaning that their parents were wealthy, but the folks, the family members are not good, but they're high school teachers. Okay. I mean, they're not making what their parents made. So they are unable to finance that difference of $1.8 million. They're unable to go into their pocket for $1.8 million. So you know what they have to do? Sell. So they're selling to the millionaires and billionaires that are again profiting from the brokenness of the family because they weren't educated. And that's what my company, HomeSure, does. I go out there and I subsidize, but I also help these people understand what they're doing. And I help them through a not-for-profit to give them a resource. So that's what I'm doing right now, in a company that I own.
is this like total, this situation totally preventable? Like if I owned a house in the Palisades, this time last year, and they're like, I just inherited it and there's this old insurance policy, like, can you basically go renegotiate that and like make sure like if there's something catastrophic happens? Cause I mean, it's like, this has been happening ecologically here.
And that's the myth. Remember, you don't set the limit of your property. The insurance company does in a homeowner situation. You don't decide what your car is worth, right? You say what you bought it for, but in the state of California, property damage is limited to actual cash value. I trust you know that as law students. No. So if you hit somebody's car and you total it, by law and statute, you're only limited in your liability for the actual cash value, which means it's going to be the replacement cost. You hit a Mercedes and it's $80,000, less the depreciation. We all know you drive a Mercedes off the shelf and it's already depreciated 25%. So your liability to the person you hit is limited statutorily to only the actual cash value, not the 80,000. So this what creates, hey, it wasn't my fault. I want the 80,000. Well, you ain't gonna get it.
You have to buy a used Mercedes.
Yeah, that's right. You see the uneducated buyer now. That's why you go, I hate you, insurance company. That's what they're legally liable for. Why do you hate me?
They don't price in sentimental value.
I mean, I'm only doing what is statutorily legal in the state of California, Mr. Driver. I'm not liable for that.
Back to the house thing, for the people that lived on the Palisades, if they reevaluated their home, like let's say it's the multi-generational families, let's say they did it right before the fires, they had the insurance company reevaluate their home, could that have been something that would have been?
No, because, again, the cost per square foot to build is a market value. So it's like anything else. If you go to buy, contractors and everything else, the cost is going to go up to 2,000. That's what we're looking at. So even if you did lose that, you added 1,000 square feet, you're still at $600 a square foot.
I think, I could be mistaken, but I think what they're asking is, can you get excess? Meaning.
Oh, no, you can't. Okay, in the homeowners market, remember, you're governed by that guy. Okay?
Covered.
Yeah. And what happens is that there's no market for excess like we do in the commercial market. Under what I've created called HomeSure, I've taken this concept and made it available to homeowners. So I'm solving the problem, okay, through a commercial solution where we can do that, but you can't do that individually. You also individually can't take $2.5 million. My company's taken the $2.5 million and not charging a premium for it because I'm a not-for-profit. I'm giving the benefit now of that $2.5 million to hundreds of thousands of homeowners, aggregating that to protect my balance sheet. But I'm doing that because I want to solve the problem. That allows me to buy insurance for HomeSure for a lot less. So my transfer price to my members is, I'm saving them 50%. I'm trying to give them a vehicle, okay? But in my not-for-profit, I'm educating them, giving them a TPA,
A third-party
administrator, which, yeah, when you buy your auto policy, who do you talk to? An agent. Well, they work for the insurance company. And if you have a loss, who are you talking to?
Not your agent.
Their adjuster, owned by the insurance company. So who's representing you? Tell me that. On your car, your home, who's representing you out there right now? These guys.
Government.
And how is that working for you? Right now, the government-sponsored program is called California Fair Plan. And they write the uninsurable risk in our state. They are $3.6 billion out of money.
Because of no, and
They don't have enough money. So you know what they're doing? They're going to the insurance companies and surcharging them $1 billion a year
For what?
to pay their claims.
What's the basis for that?
No basis. It's just because, you know what? We don't have enough money, so we're gonna do that. Well, you know what these guys are gonna do? They're gonna go
Pass it through.
and get it from you. Okay? It's all about passing the buck. Don't,
But then the government isn't the bad guy, the insurance.
yeah, remember? They're telling you that, hey, vote for me because now I've got, and I'm charging them the $1 billion. And you're going, hey, I'm gonna vote for that guy. You know, because look at what he's doing for me. You know, but it doesn't matter, it's gonna hit you in the back. Because now your premium for your auto insurance is gonna go up $1,000. So don't think that somebody's doing you a favor. What I'm trying to do is just educate you to some degree to understand this at 10,000 feet and see that this is broken. It doesn't work. It's just broken. And that there's people like me that are trying to create a balanced system. And with that, I just want to jump into this lease because I think I have maybe 10 minutes or so. If you can jump to the lease, and I just want to go over this because this is what you'll be kind of taxed with in my world. And I don't know if you have it, but here's a situation. I'll try to give you the scenario. We have a Singapore landlord. We have a high rise in Singapore. And this client is trying to take a substantial amount of floors in that high rise. They're a financial firm. Okay? They own nothing in terms of the property there except their own property. So what has happened in this lease, what's customary in Singapore in terms of transferring risk is completely different than what's done in the US. All right. So right in there, we have a conflict. All right. So what is so crazy about this is that the landlord wants the tenant to be responsible not only for their property, but if they cause a fire or any property damage to the building, they want them to pay for that.
Remember how we said we own a shopping center, for the camp charges, you can pass through insurance and all that? That's because generally speaking, the landlord is responsible for those catastrophic losses and the landlord pays for insurance and is allowed to get a reimbursement for that portion of the insurance that is relevant to the tenant. What's happening in Singapore is no. The landlord is no longer responsible
For anything.
For anything. There's such little space, good space for this product in Singapore that the landlords can basically make whatever terms up that they want because everyone wants that space.
So here we have a conflict, okay? And within the contract and within the indemnity agreement, which you'll be looking at every day in your hold harmless agreements, it's absolute one way, meaning that the landlord is taxing the tenant for not only what we would call tort law, but for any gross negligence or willful misconduct on the part of their employees, not just the tenant's employees.
So usually, if you're representing your clients, a good rule of thumb, usually, until recently, a good rule of thumb is if it's a mutual indemnification that gives the same standard, negligence, whatever it is, okay? If I do something wrong and I incur liability that causes you harm, I will indemnify you for that harm. And if you reach whatever standard of care, call it negligence, and you do something hard that some harm that causes me a loss, that you will indemnify me. It'll be a mutual indemnification. That's what used to be the case.
Now is not the case. And even if we're seeing this in landlord agreements now, because what the big thing in the US right now are server farms. Everybody wants to build server farms. That is the number one thing that everybody's building, 1 million square foot server farms. And it's in such need right now. Reality, maybe not so, it's just all talk, but everybody is killing their tenants, the Microsofts of the world.
because they're requiring them to do it all and pave the billions of
Because
dollars.
everyone wants
Everybody
Microsoft
wants-
as a tenant.
Everybody wants the space. Everybody wants that server capacity. It's at a premium. So same thing here. So what we have is an unbalanced contract. Okay. Now, to make things even more confusing, they told the tenant and my insurance company to waive or to eliminate what's called a care, custody, and control exclusion under the GL policy. So GL is supposed to be third party, the damage that I caused to you, not the damage to my building. And there's a care, custody, and
You walked in, you slipped and fell in his building, right? His general liability policy
That's my loss.
will cover his liability to you.
okay, but not the physical damage to the building. I don't own the building. So within this lease right here, there's a clause under the landlord's obligation that they're buying the property insurance policy.
Typical.
Typical, okay? In the US, it's typical to say that, hey, in the ring, you go buy insurance on what you own. I will go buy insurance on what I own. We'll create a waiver of subrogation. You know what that is?
No.
Okay. A waiver of subrogation says that, hey, in a loss, I will not sue you. I will not come after your insurance company. I will not come after you for any damages caused to my property. All right. It's balanced. It does that because that's the way insurance works. Remember, it's to say, you go to your side of the ring, you go to your side of the ring, your policy pays for what happened there regardless of negligence. My policy covers me for regardless of negligence. That's the way it's done. Now what you've done with this CGL or this liability clause by taking away their care, custody, and control, you now have two property policies on the same building. You see that? Remember, if you take the CCC exclusion out of a property contract, it becomes a property policy. It's the way it was done 80 years ago. You bought one policy, it covered everything, including physical damage. This is where the client is mixing and the landlord mixing physical damage with property damage. Property damage is a third party. It's the damage you caused to somebody else's property. Physical damage, skin PD, is the damage that is caused to your car, your property. So all of a sudden, we have a situation.
Very similar to car insurance.
Yeah. We have a situation now, we have two policies covering the same thing.
So you go to Allstate to get not only your policy for when you're leasing the car, but also your policy for the bank who owns the car.
Exactly. So now you have two policies. It's almost like writing two policies on a pen in the cap.
Usually the pen's policy covers the cap, I think.
Yeah. Why would you do that? Why would you buy a policy for the cap and a policy for the pen? They're one. You see the conflict of interest now? What's going to happen under this? And they don't understand it. The attorneys for the Singapore company are going, I want you to cover everything. You know?
Attorneys.
Yeah.
How many attorneys are on this?
Yeah, that's right. Kick it. Oh, I was on a call Friday with 12.
One lease.
One lease, 12 representatives. And I'm trying to explain, listen, in our world, insurance will cover this. You go to your side of the fence, you go to your side of the fence. But they're saying, no, I want them to cover everything.
And they're only one tenant in a multi-unit building.
Exactly.
Just to make the point clear, they're only occupied, as you saw from the lease, they're only occupied a portion of the building, but they're supposed to be held responsible for the damage to the entire building, not
So
just
there's
their
a
portion.
fire, okay? They want the tenant to cover that, but they also have a policy themselves to cover that.
I probably have another tenant with another policy that also.
Do you see how confusing this is gonna be? So we're gonna get in a lawsuit because there's $1 million, $2 million loss. And what's gonna happen is they're gonna call up my tenant's insurance policy and say,
CCC's gone, you pay for it. The landlord's gonna call up their insurance company and say, hey, fire. You pay for it. So these two insurance companies are gonna be here. And it's gonna be done on a reservation of rights, meaning that no one gets paid until we figure out,
Who's responsible?
yeah, who's responsible for this lousy, terribly written lease that was done by a bunch of attorneys, okay, who don't understand the complexity of insurance law. And who's responsible for what by contract. This is like having your cake and eating it too for the landlord. But what they're doing, they're creating, and I'm trying to educate you, you're creating a reservation of law, of rights. And all you're gonna do is blame the insurance company because we can't wrap around, you know, your own ignorance. Insurance company can't do it. So I'm gonna tell you right now, daily, I'm explaining the future. I deal in the future. And if you have this kind of thing, you're going to create a lawsuit. And maybe that's their goal. I don't know. But, you know, bottom line is I deal in more of those conflicts of interest with these types of contracts that are so poorly written that the clients blame the insurance company for doing something that's illegal or unheard of.
The example I like to give is, let's say you want to go skydiving, right? And they give you a waiver of all rights when you're jumping out of a perfectly good airplane, 15,000 feet high, but they say you can't jump before you sign, right? Now you've waived all of your rights contractually, right?
One way.
Right, one way.
One way.
And then, God forbid, the parachute doesn't open, right? Now, what happens? You think that that was an effective waiver? Hell no. Go ahead. I'm not giving you legal advice, right? But go ahead and sign that bad boy, because when, God forbid, something happens, you still have a claim.
You're still legally, as an ignorant person, you're still legally protected by, you know, Big Joe.
Statutory
And everything. So again, but that doesn't change the fact that you're going to create a lot of agony. Okay. And I've seen this come back and whiplash back, and it's the old, I told you so, but they forget about that.
The lawsuit.
You can say, well, I told you, these are my comments that I put in here. I can tell you how often the loss happens and they go, I told you right here, this is a time bomb.
And that's
Do
why.
not sign this lease. You know what they're doing tomorrow? They're signing the lease without any changes.
And that's why, as attorneys and on the bar and on the exam, right? If you see something really stupid, you're still the attorney.
Yeah.
Right? So your job is to spot that issue and say, do you want me to look further into this issue? Do you want me to come up with an alternative to this issue? But that might not be what the client wants or what the examiner wants.
Exactly.
So all you can do is spot the issue.
Yeah.
But don't forget to spot.
And these are the things that I just caution you. Divorce yourself. Don't get caught up in it, but divorce yourself at 10,000 feet and look at what happens if. I hate to say it, but you know, even with my kids, we're taught to, you know, just get so granular. And you're going to become coverage attorneys, you're going to become this kind of attorney, but you're only going to know that type of law. Okay? It's like a heart surgeon. We don't have heart surgeons anymore. We have microsurgeons that only deal with this one little piece of the heart. But if they tell you how the heart's supposed to happen and what else could be at risk, they don't know. They go to that specialist. And i.e. why we have terrible benefits now, because there's no general practitioners. Okay? Everybody wanted to be specialized. So my advice to you is learn as much as you can in school. School's not there to teach you how to solve the problem. It teaches you where to look to solve the problem. Not to solve the problem. It teaches you where to look
you know, networks, case law, all these kind of things. You're still going to have to come up with your own solution. Okay, just like this was the real world. I'm glad you put this up here because it's great. This was my real world 50 years ago. This has become my world over the last 20 years. It's almost like, consider it this way. Do you hear the word stockbroker anymore? Never. Ever? No, because you buy your own stock. Stockbroker, my brother's a stockbroker, and he was with E.F. Hutton and just retired as a, you know, like he was a wealth advisor. Okay? That's what he retired as. That's why we live in, and brokers live in an archaic world, because they like it that way. And they don't know how to change it. They still call us stock insurance brokers, but I'm not. I'm trying to change our industry to, you know, tell us that we're not insurance brokers anymore. We are really strategists. You know, I could go on to tell you other things that we're doing. A real cool thing we're doing right now is called parametric. And that's to say that if a client suffers or has risk in, like, let's say, hurricane risk. Well, if they buy hurricane insurance, it's going to cost this. But we can structure a policy that's parametric, and it says that if you have a loss, I call it cat in a circle. If you have a loss that is within reason of the location, meaning the storm front is over here and it's right here, okay, they're your asset, but you're within a statistical range with wind speeds of X and all of these interesting parametric triggers, the policy will pay you the policy limit without any adjustment. You get the check in 14 days. I did this for Dole Food Company when Dole during Iniki, was it Iniki or one of the major hurricanes? Dole Food Company, interesting. They own 21 tankers or shipping container ships, like, and so one of their most expensive costs was fuel for Dole Food, shipping all their bananas and everything all around the world. The other was paper for all the boxes that they made. Those are the two key expenses. So I created a parametric policy that would be triggered if they had a loss, like that hurricane, and it spiked the costs of paper and fuel. Well, the loss hit. They didn't lose any property. There was no physical damage. Nothing. Nothing hit them, but the loss happened within this parametric issue. So they got $60 million. No adjustment, just a check for $60 million. And that parametric policy costs this.
Can you do that for a house in Palisades?
Yeah. That's the thing, those are the things that I'm doing right now, okay? So we're bringing the commercial aspect, and there's not a lot of us doing it because most people just don't understand it at that level. But we're starting, again, to take the risk in here, which you're gonna get anyways nowadays, okay? Homes, your deductible ain't gonna be $1,000 anymore. It's gonna be 100,000, 500,000, $1 million for people that wanna build on the coast.
And again, if you have a high deductible, effectively that means that you're accepting more risk of loss.
That's correct. And
That's
so,
all that means.
yeah, so I'm teaching my clients, again, not just captives, like we talked about, but parametric ideas and off-balance transfers to more and more get rid of the insurance companies here who are charging huge amounts of money, but also with the maybe I'll pay you. And
I mean, that's the point of your law.
Lawyers make a lot of money with maybe.
Yeah, so you realize that, you know, these are kind of things you should think about when you go out and start talking to, you know, prospective employers. This is what's going to differentiate, in my opinion, your practice. Is working these things that I'm telling you into conversations during your interview that you're now telling your client, I'm not going to be expense to you. I'm going to make this a profit department. We're going to make money on this. And you're going to get hired over that other person coming from USC. Okay?
Or a better school.
Yeah, or a Harvard. Because they're just I call them a Joe bag of donuts. Joe bag of donuts is just, hey, you come in with donuts, you get ready to donut, and go, hey, what business do you have for me? Those days are gone. We need more sophistication. You need to be more sophisticated. And you need to help your clients navigate what is going to be, you know, an AI explosion, as they say, but just the complexity that I never saw, that I'm seeing now. But also, how can I drive top line revenue for my client?
Now you guys understand how I introduced you last week before you got here. I said that the person you're going to meet is the person who is more than anyone else responsible for me at the age of 50 starting a new career in insurance. Because when I met Mr. Anderson and a random networking lunch that a banker told me to take, and I don't usually just take blind date lunches.
Yeah, he met me at the Hollywood Hotel.
Yeah.
He came in and go, why the heck am I here? You know?
Yeah, basically. So, but changed the course of my life, because what he was able to show me is how much of an idiot I was, because unlike you, I had already been in real estate as a professional, right, for 20 odd years, right? And even as a real estate professional, doing okay, quite well, right? I had no idea that there was no effective transfer of risk going on as I was bleeding away every year in premium costs for insurance. All I ever did was negotiate. And I thought I have to get better at negotiating, because every year this premium is going to be renewed. This policy is going to be, I got to get better. I thought that was the name of the game. So I just got to learn from, you know, the Strauss Institute down the hall, right?
Exactly.
But it turns out that that wasn't the most important thing. Most important thing was understanding coverage, the tower
Understanding
coverage,
risk,
and understanding risk.
retaining risk. I mean, you retain risk every day you walk out of here. You're retaining risk all the time. Step off a curb, get hit by a bus.
Jaywalking, don't jaywalk.
Yeah, you know, there are things, but there's ways to mitigate that, to capitalize on what insurance companies have been capitalizing on for the last 150 years. Do it yourself. Remember, you go into Jack in the Box, you order from a kiosk now. There's some person in the back making it. You don't even interact anymore. I tell my clients, you have to be responsible now for your own actions and do these kind of things, because there's no one out there helping you. Again, in my business, understand, I mean this, in my business, talent is ankle deep. It's all about selling insurance, not knowing what you're selling, and move on to the next town and do it again. There's so few of us that have really been Berean in this process to really be of value to your clients. And all my clients are attorneys. I mean, I hang out in a law department, and that's another thing I offer you too. If you ever want a network or an introduction to somebody in where you're headed, chances are I know somebody. At 45 years of educating people, and that's what I do now. And I put 3 kids through the school. Okay. As a matter of fact, all 3 work here now. Okay.
So I'm bored.
Yeah, and I've been on the board and done things to help the school. So
I think that's a good place,
Yeah,
to
yeah,
call it.
yeah.
So everyone, thank you, Mr. Anderson. And we'll tell each other, that the best, IBT class was only tangentially related to international business transactions, but actually was integrally related to every single.
Yeah, give me over, and again, send my email to them. If you ever want to talk, you ever have a problem, you're looking for an end with a, you know, a law firm or a real estate group or a food manufacturing group or what have you. I know, I just know a lot of inside counsel people. And I can network you in, to get you employed.
If you want to be bailed out, call Dale.
Yeah, I do that. I'd like